For his take on the Canadian real estate market, we're joined now by our featured guest of the morning. He's Bruce Murray, Chief Executive Officer and Chief Investment Officer at Murray Wealth Group. And as you can see, he's in our studio right now. Thank you so much for coming in.
You're welcome, Paul. Good morning.
Good morning. Any quick thoughts on what we were just talking about with Derek DeCluet?
Well, I mean, I think it's pretty obvious that the rise in rates has put a squeeze on housing, and especially if you've got a mortgage that's going to mature in the next couple of years, you're probably coming off, something. I actually have a couple of mortgages I got at 1.8%. They're going to go to 5.5%, 6%. Mm-hmm. It's going to put a squeeze. It's going to reduce housing prices until we get some sort of relief. And I mean, the global banks, the global central banks have been trying to squeeze this inflationary bout out. It appears they're pretty well on the way. They've got a target of 2% in the U.S., which is obviously the key market. I think we've seen some of the more recent numbers down to 2.5%. So we're almost there. I mean, I think they want to make sure they kill it. So, I mean, I think Canada may be a little ahead of the U.S. in cutting rates, but the U.S. is probably going to hold them into mid next year just to, when you go to a doctor, they tell you to take the full prescription.
That's right.
So I think it'll be something along that line that we're going to see. But we're pretty optimistic that this is going to be good for a lot of stocks. It's not going to be great for housing, though, and my wife's a real estate agent, and business is pretty dead. So
let's. I was going to. My next question was the stock market. That's your business.
Yeah.
What do you think of this market rally that we've seen? This great rally we've seen during November, connected, of course, to the expectation of lower interest rates.
Yeah. So I think if I don't think you can put up a chart of the S&P 500 with the S&P earnings, but S&P earnings peaked about the same time as the market was bottoming. So the market, does lead the economy. It's one of the leading indicators. Way back in university in economics, we learned the stock market was the key economic leading indicator. And so we saw the market sell off while things were rising. It's turned around, a couple of times over the last year, but now we've seen rates actually starting to rise. And so, earnings starting to rise. So I think we're in good shape. I mean, earnings are going to be higher. The companies have adjusted to this new environment gradually. We've seen this rolling recession go through retail. We've seen a lot of retail stocks all of a sudden doing better because they've caught up. The inventory cycle has caught up. We still have an inventory cycle to hit us my daughter ordered a Toyota 2 years ago. It still hasn't been delivered. So there's still a catch-up from the pandemic going to flow through the economy, over some time. But eventually, my dad was a steel buyer. And when he couldn't get steel, he ordered it from everybody. And when it came, they just stopped buying. And that's when the inventory sort of correction, which leads to a recession, happens. And so we still may have something like that in the future.
Okay, that's Bruce Murray. He's our featured